Assalamualaikum Dr. Adwa. We are from Wednesday, 9 a.m. to 12 p.m. class session. Our group consists of 3 people, which is me, Putrina Balkish, Siti Murni, and Wan Nur Shafiqah. Let's begin with our presentation. As everyone know, MIA is stand for Malaysian Institute of Accountants, which is one of professional body in Malaysia. MIA had created laws for accounting profession which is called MIA bylaws. The latest revision come into effect on 15th of June 2019 and these laws issues in pursuant to Section 10 subsection A of the Accountant Act 1967, which means all members in MIA are binding to it. The aim for this law is to safeguard the public interest and professional and business relationship. Why this law is needed? Because accountancy is one of the jobs that play a significant role in the society. With the laws, it will help the members in the body to act in a high standard of professionalism and professional conduct that are expected by the profession. Therefore, our group had chosen 3 sections. Section 100, which is complying with the code, Section 210, conflict of interest, and Section 511, loan and guarantees. Let's start with the first section, which is Section 100, where it is talking about complying with code. The first question asks, can professional auditors or accounting firm defy the code? The first answer is yes. So, what would be the conditions that allow the professional auditors or accounting firm to defy the code? There is only one condition. Based on Section R100.3, if the laws and regulations preclude the accountant from complying certain parts of codes. For example, if the auditors are outside of Malaysia and they found out the local laws and regulations are prohibited them to receive any gift from clients. Therefore, they must obey the local laws and regulations, even though it is not prohibited for us to receive them in our jurisdictions. Next answer is no. Why? Because the professional auditor or accountant must act in a public interest and not exclusively to satisfy the need of client. This is based on section 100.1A1. In addition, according to section R100.4 and section 100.4A1, if anyone breaches the codes, they will evaluate the significance of the breach and the impact of the professional auditors or accountants' ability to comply with the codes. So, which threats may arise that making them to defy the code? There are 5 threats that may possibly arise: self-interest threat, self-review threat, familiarity threat, intimidation threat, and advocacy threat. Now, let's talk about the first threat, which is self-interest threat. This threat holds either direct or indirect financial interest, which is it will influence the professional judgment and behavior. For example, the auditor audits the same client in 2020. However, because they are not received yet the audit fees in 2019, this will influence their judgment and professionalism on their job. Next, self-review threat. This threat occurs when the previous judgment needs to be re-evaluated by the professional accountant who is responsible for that judgment. For example, Ms. Nina has recently joined a firm of chartered accountants. The firm intends to depute her on the audit of Sky Berhad. Prior of joining the firm, Ms. Nina had been prepared the company financial statement to Sky Berhad for many years. Therefore, because of the previous provision of preparing the financial statements to Sky Berhad and long association of Ms. Nina with Sky Berhad, this will create self-review threat. Not only self-review threat, but also familiarity threat. What is familiarity threat? Familiarity threat is occurring when the auditors have a very close relationship or familiar to employees, directors of client's company, or officers. For example, Blue Berhad has been audited by the same auditor for over 10 years, and the auditors regularly hang out with the CEO and CFO of Blue Berhad. Because of this close relationship of the auditor with the CEO and CFO, it has created the familiarity threat. The next one is intimidation threat. This threat may occur when a professional auditors or accountants may be deterred from action objectively by threats, actual or perceived. They might be threatened with dismissal or replacement in relation to client engagement with litigation or being pressured to reduce it appropriately to the extent of work performed in order to reduce fees. Lastly is advocacy threat. This threat exists if the auditor is involved in promoting the client to the point where their objectivity is potentially compromised. For example, the auditor is assisting in selling YTL Berhad while at the same time serving as the auditor for the company. Another example is the auditor acts as an advocate for an assurance client in litigation or dispute with third parties. Next question is, which fundamental principle would be affected? The answer is, all fundamental principles would be affected because all of them are related to each other. The first fundamental principle is objectivity. The auditor must make an unbiased decision and it must benefit the clients. The next one is integrity. Based on section 100.1A1, as professional auditors or accountants, you must honest and straightforward in all decisions in order to act in a public interest and maintain the professionalism. Confidentiality. Whenever you acquire your client's information, it must stay confidential and do not use it for personal advantage or the advantage of the third party. For professional competence and due care, you have to evaluate yourself and know your skills level. Ask yourself either you have the expertise within the area or not. If no, please do not advocate it. Lastly, professional behavior. According to section 100.3A1, professional auditors or accountants shall comply with the code, the laws and regulations that fall into their jurisdiction and body's work. For the last question, how to reduce the threats to an acceptable level? The answer is safeguards. Safeguards are necessary when the auditor concludes that the identified threats are at a level at which compliance with the fundamental principle is compromised. Safeguard falls into two broad categories. The first one is safeguards created by the profession, legislation, or regulation. This may include the requirements of professional standards, corporate governance regulations, and education and training of auditors. For example, the first one, policies and procedures to implement and monitor quality control of engagements. Second, continuing and reviewing professional requirements. Next, professional or regulatory monitoring and disciplinary procedures. And lastly, external review by a legally empowered third party of the reports, communications, or information produced by a professional accountant. Next, safeguard in work environment. This safeguard is fall into another two types, and those that are firm-wide and specific engagement. Examples for firm-wide: number one, a disciplinary mechanism to promote compliance with policies and procedures. Number two, policies and procedures to implement and monitor quality control of engagements. Next, we go for example for specific engagement. The first one, rotating senior assurance team personnel, and lastly is consulting an independent third party. For example, regulatory body or committee of independent directors.
Next, moving on to conflict of interest based on Section 210 MIA bylaws, can a professional auditor or an accounting firm provide services that rely on conflict of interest? The general principle states that A professional accountant should not allow a conflict of interest to compromise professional or business judgment. Therefore, the answer is no. This is because conflict of interest is strictly against the MIA bylaws and also ethics conduct in a professional profession as an auditor and also accountant. There are five traits that may arise. First, self-interest, which is the trait which in the condition of the auditor or the accounting firm could benefit from any information that they had gathered for their own interest. For example, a financial interest in a client or jointly holding a financial interest with a client. Next, it also may be undue independence on total fees from a client or having a close business relationship with client. Second, self-review. It may occur as the auditor in position of reviewing work that they have been responsible for. For example, the discovery of a significant error during a re-evaluation of the work of the auditor. And it also maybe can be the reporting of the operation of financial system after being involved in their design or implementation. Advocacy trait, which the auditor had promotes and audit client's position or opinion, for example, selling, underwriting, or otherwise dealing in financial securities or shares of a client, and it also acting as an advocate on behalf of a client in litigation or dispute with third parties. Fourth trait, familiarity. By virtue when the auditor having close relationship with the management, employees, which possibly make the auditor or accountant become sympathetic in making decision or judgment. For example, intermediate family member or close family member who is a director, officer, or influential employee of the client. It also can be long association of a senior member of the team with the client. Last but not least, intermediation trait, which occur when a professional accountant may be deterred from acting objectively by trait, either actual or perceived. Next, which fundamental principles will be affected due to conflict of interest? There are four fundamental principles that will be affected due to the conflict of interest, which is integrity, objectivity, confidentiality, and professional competence and due care. Integrity in a condition which the auditor are required to be straightforward and honest in all professional regardless any benefit that offered while exercising duty. Objectivity. The auditor should not compromise professional or business judgment as to avoid being biased and involved in conflict of interest. Confidentiality. It is compulsory to the auditor to respect the confidentiality of the information, meaning not to disclose any information to anyone unless it under legal or professional right. Last but not least, professional competence and due care. The auditor should maintain professional knowledge and skills according to the standards and act diligently in accordance. Next, how to reduce the threat to an acceptable level. First, framework is crucial helps to identify threat which using the fundamental principle as guidance and also ways to mitigate. Next, relevant practical training and experience, which means the auditor should continually improve its technical services and keep his knowledge up to date, and also must exercise due care and diligence in discharging his duty. For more education, it's also important to create more awareness not just to the professional services provider but also the parties that involved directly or indirectly in the particular business.
Proceeding to the last section, section 511, loans and guarantee. So, the first question in general, can professional auditors or accounting firms make loan or guarantee a loan to audit client? We have a no answer and also a yes answer. It is a no if the loan is material, where materiality is determined as to the combined net worth of the individuals. So let's say if the loan is material to either the auditor or audit client, therefore the loan is prohibited. And it is a yes if the loan or guarantee of loan is immaterial to either the auditor or the audit client. The second question has two parts as it specifies if professional auditors or accounting firms can make a loan to audit client, which is the first one, a bank or similar institution, and the second one, not a bank or similar institution. So for the first part, specifically, can professional auditors or accounting firms make a loan or guarantee a loan to audit client, which is a bank? It is a no, as general rules has stated that any loans or guarantee of loans are prohibited. It is a yes if the deposit or account is held under normal commercial terms. However, we must note that self-interest threat might arise if it is material to either the audit client or to the firm receiving the loan. Moving on to the second part of question number 2. Specifically, can professional auditors or accounting firms make loan or guarantee a loan to audit client which is not a bank or similar institution? So it is a no if it is material to either the auditor or the receiving firm. It is a yes if the loan or guarantee of loan is immaterial to audit client or the receiving firm. So for question number 3, which fundamental principle would be affected? In my opinion, there are two fundamental principles that would be affected. The first one is objectivity and the second one is professional behavior. So first, I will explain how loan and guarantee of loan would affect objectivity of a professional auditor or accountant. First and foremost, we must aware that professional auditors and accountants cannot compromise any professional judgment because of bias, conflict of interest, or undue influence of others. Therefore, for this section, an auditor or accountant cannot undertake any activities if they have relationship with their client, either it is a relationship of lender-borrower or a grantor-guarantee relationship. This is because they will tend to be biased as they had relationship with the client. The second fundamental principle that will be affected is professional behavior. A professional accountant or auditor must serve their client with professional competence while applying their professional knowledge as they're performing professional activities. But for example, if an auditor or professional accountant had a loan from one of their clients, the professional behavior will surely be affected because they had engaged in an activity that can impair their objectivity. For the last question, how to reduce self-interest threat to an acceptable level? So, like I have mentioned before in question number 2, a self-interest threat will present if the loan or guarantee of loan is material to the auditor or the audit client. So, by having the work reviewed by an appropriate reviewer who is not a team member and also not a beneficiary of the loan, that person also should be completely unrelated with the loan or guarantee of the loan that will review without any bias. He will definitely be objective and appropriately behave as a professional as indicated from MIA. That's all from our group. Thank you.